Are you 50 or older and starting to think more seriously about retirement? You've probably heard about two main accounts, the 401k and the IRA, but which one is better for you? In this video, I'll explain the differences in very simple terms, step by step. By the end, you'll know the pros, the cons, and one clear action you can take this week. Hi, I'm Mark Davis, and I make videos to help people make smarter money choices without all the confusing financial jargon. Today, we're going to cover four things. One, what a 401k is. Two, what an IRA is. Three, the key differences. Four, and finally, which one usually makes more sense if you're between 50 and 65. Part 1. What is a 401k? A 401k is one of the most common retirement savings plans in America, and it's something your employer sets up for you. The way it works is simple. Money comes directly out of your paycheck and goes into your 401k account before you even touch it. That means you don't have to remember to save. It happens automatically. Now, here's one of the biggest advantages. Many companies offer what's called an employer match. For example, if you put in $1, your company might add 50 cents, or sometimes even another full dollar. That's like getting an instant bonus. It's free money, and it grows right alongside your own contributions. If your employer offers a match, the smartest move you can make is to contribute at least enough to get every dollar of that match. In 2025, the government allows you to put in up to $23,500 of your own money each year into your 401k. And because you're over age 50, you're allowed to make what's called a catch-up contribution. This is extra money you can add beyond the regular limit to help you save more quickly before retirement. For people between ages 60 and 63, new rules even allow larger catch-up amounts, giving you an extra push as retirement gets closer. Part 2. What is an IRA? An IRA stands for Individual Retirement Account. Unlike a 401k, it isn't connected to your employer. You don't need your company to set it up. Instead, you open it yourself through a bank, a credit union, an investment company, or even an online investing app. That means you have full control over when and where you start. Now let's talk about limits. For 2025, the maximum you can contribute to an IRA is $7,000 per year. If you're age 50 or older, you're allowed to add an extra $1,000 as a catch-up contribution. That brings your total to $8,000. While that is much less than the 401k contribution limit, the IRA has an important advantage: choice. With a 401k, your investment options are limited to whatever funds your employer's plan offers. Some plans are good, but others may be expensive or very narrow. With an IRA, you usually get to pick from thousands of investment choices. You can keep it simple with a low-cost index fund, choose exchange-traded funds, or even go with a target-date retirement fund that automatically adjusts risk as you age. So think of the IRA as your personal retirement toolbox. Smaller limits, but much more flexibility and control. Part 3. Taxes made. Simple. Let's make the tax rules around retirement accounts as simple as possible. Both 401ks and IRAs come in two main types, traditional and Roth. First, the traditional 401k or traditional IRA. With these accounts, the money you contribute goes in before taxes. That means you can lower your taxable income this year, which could reduce the amount of income tax you pay right now. The trade-off is that when you retire and start taking money out, every dollar you withdraw is taxed as regular income. So you save on taxes today, but you pay them later. Second, the Roth 401k or Roth IRA. With Roth accounts, your contributions go in after you've already paid taxes. You don't get a tax break this year, but in retirement, the money you take out, including your growth and investment earnings, can be completely tax-free as long as you follow the rules. That's a powerful benefit, especially if you think your tax rate might be higher in the future. Here's one more important detail. Roth IRAs have income limits. If you earn above a certain amount, you may not qualify to contribute directly. A Roth 401k, on the other hand, usually doesn't have that restriction. which makes it more flexible for higher earners. Part 4. Why the 401k often comes first. One of the smartest starting points for retirement savings is the 401k, especially if your employer offers a match. Here's why. When your company matches your contributions, it's like getting an immediate bonus on your money. For example, if you put in $1 and your company adds another 50 cents, that's a 50% return instantly. If they match dollar for dollar, that's a 100% return the moment you contribute. There is no other investment out there that gives you that kind of guaranteed return, risk-free. That's why financial experts often say, always take full advantage of your employer's match before looking at other accounts. Another big advantage of the 401k is the contribution limit. In 2025, you can put in up to $23,500 each year, and if you're 50 or older, you can add extra catch-up contributions on top of that. Compare that to the IRA, which only allows $7,000 or $8,000 if you're over 50. The difference is huge. For people in their 50s and early 60s who may feel like time is running short, the 401k allows you to save larger amounts more quickly. Between the company match and the higher contribution limits, the 401k is often the best place to begin. Part 5. Why an IRA can still be powerful. Even though the IRA has lower contribution limits compared to a 401k, it's still a very powerful tool for retirement savings. The biggest reason is flexibility and choice. With many workplace 401k plans, your investment options are limited. Some plans only give you a small list of funds, and sometimes those funds come with higher fees. Fees might not sound like a big deal, but over time, they eat away at your returns. Paying just 1% more in fees each year can add up to tens of thousands of dollars less in retirement savings. An IRA gives you much more freedom. You can shop around and choose low-cost index funds or exchange-traded funds, ETFs, that keep fees to a minimum. That means more of your money stays invested and working for you instead of going to fund managers. This is why many people use both accounts together. First, they contribute enough to their 401k to get the full employer match. After that, they put additional savings into an IRA. This way, they take advantage of the free money from the 401k while also gaining more control and lower costs through the IRA. It's a smart 1-2 approach. Part 6. Fees, Rules, and Age Limits. Let's take a moment to talk about some important rules that can really affect your retirement savings. First, fees matter. A fee of just 1% may not sound like a big deal, but over 20 years, that small number can take away tens of thousands of dollars from your nest egg. Always check the expense ratios or fees in the funds inside your 401k. If the fees look high, that's one reason many people also open an IRA, where they can choose low-cost funds. Second, let's talk about catch-up contributions. If you're 50 or older, you're allowed to save extra money each year in both 401ks and IRAs. This rule is designed to help you boost your savings as retirement gets closer. It's a valuable opportunity, especially if you feel you need to make up for lost time. Finally, there are age rules for withdrawals. Starting at age 73, most people must begin taking money out of their traditional 401k or traditional IRA. These required withdrawals are called Required Minimum Distributions, or RMDS. Roth IRAs, however, are different. You are not forced to take withdrawals during your lifetime. That flexibility makes the Roth IRA a useful tool for long-term planning. Part 7. Real-life Scenarios. Now let's look at a few real-life situations, because knowing the rules is one thing, but knowing how to apply them is even more important. Scenario 1. You have a 401k and your employer offers a match. The smartest move is simple. Contribute at least enough to get that full match. It's free money and it should always be your first priority. Scenario 2. Your 401k plan has very high fees or only a few investment choices. In this case, still get the full employer match first. But after that, consider putting your extra savings into an IRA. With an IRA, you can pick low-cost funds and keep more of your money working for you. Scenario 3. You want to save as much as possible. Here, the strategy is to max out your 401k contributions, especially if you're over 50 and can make catch-up contributions. Then, if you're eligible, add more savings into an IRA. This combination helps you build wealth faster. Scenario 4. You're getting close to age 73. Remember, that's when required minimum distributions, or RMDS, begin for traditional accounts. Some people plan ahead by moving part of their savings into a Roth account to avoid forced withdrawals later in life. Part 8. Action steps for this week. To make all of this easier to put into action, let's break it down into 3 simple steps you can take this week. Step 1. Log into your workplace 401k account. Check if you're contributing enough to get the full employer match. If you're not, adjust your contribution right away. Remember, that match is free money, and you don't want to leave it on the table. Step 2. Take a look at the fees in your 401k funds. You can usually find them under expense ratios. If your plan has high fees, that doesn't mean you should stop using it. But it may mean you should consider opening an IRA on the side. With an IRA, you can shop around for low-cost funds, which can save you thousands of dollars over time. Step 3. Decide whether a traditional or Roth account fits you better. Ask yourself, do you want the tax break now or later? If you expect your taxes to be higher in retirement, a Roth could be smarter. If you'd rather lower your taxable income today, a traditional account may work better. These are small steps, but they can make a big difference. So, after all this, which is better? A 401k or an IRA? The truth is, there isn't one single winner. Both accounts have unique benefits, and in many cases, the best approach is to use them together. Think of it this way: your 401k is often the first tool to use, especially if your employer offers a match. That match is free money, and it gives your savings an immediate boost. Plus, the 401k allows you to contribute much larger amounts each year, which is very helpful if you're in your 50s or 60s and trying to build up savings quickly. Once you've taken advantage of the match, adding an IRA can give you more control and flexibility. With an IRA, you can choose from thousands of low-cost funds, ETFs, or even simple target date funds. It's a way to keep your costs lower and your choices wider. So instead of thinking of 401k and IRA as rivals, think of them as a team of tools that can work together for your retirement. If you found this video helpful, I'd love it if you gave it a like and hit subscribe. I'll also leave some links to official IRS pages and simple guides down in the description. Thanks for watching, and here's to a retirement that feels comfortable and confident.